could be wiser as an educated advisor. Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, tax correlation of investment products, part 2 in our series on index universal life insurance. All here on Let's Get Down to Business.
AMT, again, remember, we just updated this, right? It's funny, everybody says, hey, we don't no longer have it. No, we still have it. They just updated it. They marked it to inflation, brought it into the 21st century. But bottom line, we're still paying and exposed to it. And remember, it's not just municipal bonds that can cause alternative minimum tax. So there's other tax preference items, right? Like oil and gas leasing, as I've said before. Some of the big players love it because the deduction on depreciation is so huge. But heads up, if you load too much up on it, the government's going to say, that's a preference item, you're trying to escape taxation, we're going to at least tag you with a minimum alternative minimum tax. So just keep in mind, those are the issues. And remember, IUL, Index Universal Life, TAMRA compliant design is never going to have any of these issues. Capital gains. Well, I don't know about you, but if you have non-qualified monies and mutual funds and ETFs, maybe even some real estate REITs, I want to have profits. And the longer you hold it past a year, it's going to go from ordinary income tax treatment to capital gains tax treatment, which is where you want to be. Now, there's 3 levels of capital gain. Most clients think that they're in the 15% lowest capital gain treatment bracket. It's never true. It's almost always 20, and sometimes, because of Obamacare, 23.8. In this case, a gentleman, a friend of mine, who I was not actually his broker at the time, said, Steve, I saw your show on taking some money off the table. He had just watched Jim Cramer on the MSNBC, and he says, hey, we need to always remember to take a little profit off the table. Don't leave it on there. You don't just always take some money off the table and park it. So he was talking about time to take it off. So this guy said, I've been in these mutual funds for such a long time. I think I'll go ahead and sell it off. The problem is that he didn't think about taxation at all when he sold it off. So when he sold it all. Now think about it. He came to us in November, and this is something, if you're a sales or marketing person, this is one of those things when you start creeping into October, and you're going to have people funding annuities, funding life insurance. You need to go heads up. If we sell off your security position, how many brackets will that actual income push you up? So what do I like to do? I like to say, we'll take some on this side of the year in November or whenever you want to do it. And then in January, we take the rest. Spread my tax liability. Let me tell you, this guy sold off and he pushed himself into 3 elevated brackets. So his normal bracket, you think about this, he was paying capital gains, right? And it put him, he says, well, I don't worry about it, I'm just paying capital gains. But when I told him it was not 15, it was 23.8, he had a major league Tourette's episode. And on top of that, think about this. All that capital gains, all of it, went over to the provisional income test, bumped him into Tier 2 taxation for Social Security. Now he's paying ordinary income tax because of a what? A capital gain transaction. See, this should be antithetical. We should be going, no way, this is not right. So here we are again. Does IUL ever cause a capital gain? The answer is no. And on top of it, as long as it's TAMRA compliant, and on top of it, will we transfer any kind of distributions from IUL? Does it ever fall in the provisional income test for Social Security? Answer, no. So remember, it's ordinary tax-free, and it's never dickers with my Social Security. So that's tax-free. Those 2 issues combined, even if I had a lousy return on my contract, let's say over 10, 15, 20 years, and it was only, I don't know, let's say 6%, which is kind of average, right? But it would be 6% with no ordinary income tax and 6% not causing any taxes on my Social Security. See, now we're in the gross up rate of 9. Maybe it depends upon the guy's bracket, right? 8.5%, 9%. That's worth looking at. And keep in mind, what was my beta risk? They'll never credit less than 0 on the crediting side of the equation. So I'll never have negative numbers on the crediting. Now remember, you could have negative numbers if you still have to pay the policy fees, and that's all true. I'll get to that in a little bit. So capital gains, AMT, ordinary income tax, golden. And here's a little chart that draws out, or most people say, I'm in the 15% tax bracket. But an affluent client that's making money, if he's in 6-figure land, he's probably in the 20%. And if he's in the $250,000 adjusted gross income or more, they could be paying an extra 3.8. That's what Obamacare did. It had nothing to do with, think about this, it had nothing to do with insurance, medical. They just threw this on people who were making money. So whether you think that's a good idea or not, I leave that to your ideology and your politics. Now, these are some of the correlated issues that I deal with all the time. FIFO and LIFO, and I want you to hear this out. This is a major teaching for marketing and salespeople. Do you realize in 1982, back in the day, when we took out a mutual fund that was a non-qualified mutual fund, we got to take all the basis out first. And what is basis under the code? It's the return of the money that you contributed or invested, right? That money comes out free. So we'd all celebrate that. But in 1982, they say, we need the revenue now. They're going to switch it. All your gain comes out first. So it used to be called first in, first out. Now it's called last in, first out. So when I go and surrender a contract to use, for distribution, for whatever I want to buy, whatever trip I want to go on, whatever I'm going to use it for, the gain comes out first, taxable. I don't get to recover the basis till later in the game. So this changed, except for 2 exemptions to the code, and we own both of them. If you're selling a lifetime annuity, it could be a single premium immediate annuity. It could be a deferred income annuity. It could be an indexed annuity with an income rider. If you jettison and trigger lifetime income, right, that income is going to, non-qualified, is going to amortize your basis at the front end of the contract. You'll still have to pay some tax on some interest, but they're going to give you some of the basis back at the front end, not at the back end like we do on every single thing that is out there in the market. So I want to encourage you really fast. This is an area that people forget when they're on the phone, when they're marketing and talking to different people, especially the more affluent client. This really matters, right? You're talking to a top-of-the-line advisor, an insurance agent who knows what he's talking about. These people understand this, and I always bring it up. And remember, I'm one of the few exceptions to the old laws under TEFRA. The FIFO rule still applies for me in a good percentage of my lifetime income annuities. And on top of that, in a TAMRA compliant contract, I can take withdrawals of basis, my original contributions, and as long as I take those out in the year that I can validate that I passed the force out rule, I don't want to drown you with too many rules here, I could take that money out free. So the only people that are allowed basis in the more FIFO tradition, rather than what we've been doing since 1982 called LIFO, last in, first out, this is another advantage of life insurance and annuities that none of the other products have. So I just implore you, think about this. Basis matters on life contracts, especially TAMRA compliant, and basis matters when you're returning on lifetime income. Everybody's playing lifetime income, single premium immediate annuity, deferred income annuity, or an indexed annuity with an income rider. It doesn't matter. People love this. Money you can't outlive. What if I live so long that I break the Guinness Book of World Records? Jean Clement's 122 years, 164 days. They're paying that premium to you all the way out. What if you're America's tricentenarian? She just died in May 2016. She was born in 1899. She lived throughout the 20th century, and she died May 2016. She died at 116. They euphemistically call these gals on the web, they call them tricentenarian teenagers because they're in their teens plus 100, right? So it's pretty remarkable. But if Susanna Jones, who died at 116, had a lifetime annuity, they would have paid all the way out. Think of it. Ida Mae Fuller was the first person that received a check from Social Security. Her total all in, this is everything she ever contributed, was less than 25 bucks. Everything. She was supposed to die at 62. She didn't die at 62. She lived on to age 100. She took $22,888 from the Social Security system. She was supposed to be dead 30 years before that by the actuarial tables. So listen, the longer you live, this is going to be huge. And if you're using non-qualified lifetime annuities, you're going to get some of that basis up front, which is exactly what we want. That's why it's a cool idea. I talked about capital gains. Estate tax is the same way. There are few exceptions for IUL death benefit. Most Americans are going to be below the unified credit mark, so they're not going to worry about their death benefit being taxed or being part of their estate where it would get taxed. And on top of this, keep in mind, this thing's called phantom income. I had a client, he says, I've been taking all this income out all this time, tax-free by loans. So his attorney said, Steve, I just did an in-force ledger, and it looks like we're going to run out of gas here in about a couple of years. There's not going to be any money left. And I said, well, that's a problem, because if your client's alive and that contract terminates, If he's not dead by then, he'll want to be, because he's going to pay ordinary income tax on all the gain on that contract. So, heads up. What's the big key here? Am I using an IUL contract that's going to have enough money at the endowment or maturity date? It matters. So sometimes if I see longevity, and I see this in females all the time, their mom, their aunts, people in their family tree are living into their 90s, I'd get spooked. And I said, I better make sure that my maturity date goes all the way out to 105, maybe 120, right? And remember, our contracts now all go out to 121. There's some out there that they actually illustrate. I don't know if their endowments are this, but some of those illustrate to 130. So it matters.
Don't forget to watch our next segment on the Tax Bracket Racket, part 3 in our series on Index Universal Life Insurance. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or compliance officer. And don't forget to subscribe to my consumer show, Steve Savant's Money, the name of the game. Daily content that you can post on your website, social media accounts, and database distribution. I'm Steve Savant. Thanks for watching.